Welcome to the Way of Wealth. I'm Corey.
And I'm Lily. Corey, I saw some news the past couple days saying Hong Kong is launching a gold clearing system in July to challenge London. What's really going on here?
The timing you're noticing is absolutely critical. The Hong Kong Special Administrative Region government plans to launch a government-backed gold central clearing system in July 2026. The target is very clear. They want to challenge London's nearly 200-year dominance in global gold trading.
200 years? That power structure sounds deep.
It is. The London Bullion Market Association, or LBMA, controls global gold pricing power not because they have the biggest vault, but because they control the clearing system. Whoever controls the clearing system controls pricing power. Hong Kong is now copying London's architecture using an unallocated account mechanism. 11 banks have already joined the board, including 6 major international banks. More importantly, Hong Kong plans to expand its gold storage capacity to 2,000 tons over the next 3 years. That scale is no longer symbolic.
Unallocated accounts? That doesn't sound like the physical holdings we always emphasize.
Correct. Unallocated accounts mean you don't hold specific serial numbered bars. You hold a gold claim against the clearing institution. This mechanism does improve liquidity and allows large-scale transactions to settle faster, but it's essentially still a form of paper gold. For our listeners, the significance of this system isn't whether we should participate, but what it reveals about a bigger trend. Global financial power is shifting from west to east.
So, Hong Kong going live in July, this is a direct east-west confrontation on financial infrastructure?
You could see it that way. When a clearing system is established, the physical flow of gold follows. Historically, whoever controls the settlement rails is where gold flows. What we're seeing now is that mainland China has already established the foundation through the Shanghai Gold Exchange and Shanghai Futures Exchange. Hong Kong's system creates an international-facing window on top of that foundation. The two complement each other, forming an Eastern gold pricing center. And this January, Hong Kong and the Shanghai Gold Exchange signed a cooperation agreement. This isn't a solo effort, it's an organized strategic deployment.
That makes me think about something. If the East starts controlling pricing power, how will the West respond? Will there be some kind of financial conflict?
That brings us to another important framework. Many people assume that the current high inflation environment will eventually end in a sudden deflationary collapse, stock market crash, real estate implosion, all assets going to zero together. But veteran silver market analyst David Morgan proposes a more nuanced view. What's more likely to happen is a quiet, hidden credit contraction.
Quiet and hidden? How is that different from a sudden collapse?
A sudden collapse is dramatic, everyone can see it. But credit contraction is gradual. You'll notice, banks become unwilling to lend, businesses can't get financing, consumers' credit card limits get reduced, liquidity evaporates bit by bit, but on the surface, the market still operates. Prices still fluctuate, until one day you suddenly realize your paper wealth can no longer be converted to cash. That's the most frightening part. For example, your house might still be worth $1 million on paper, but when you want to sell, you can't find a buyer, or the buyer can't get a loan. At that point, your wealth is locked.
In that scenario, how would gold and silver perform? Would they be affected?
Great question. Morgan cites research from economics professor Roy Jastrom, who wrote a book called The Golden Constant, studying silver's historical performance from the 13th century onward. The conclusion: silver's performance varies. It's not as stable as gold. But one thing is certain: silver performs best in inflationary environments. In deflationary environments, silver gets pressured due to its industrial properties. But because it's still a monetary metal and highly correlated with gold, it still provides some protection. More importantly, silver is an indispensable raw material for all tech products, from phones to solar panels, from electric vehicles to medical devices. Everything needs silver.
What about the 2008 financial crisis? Didn't gold and silver both crash initially?
Yes. The lesson from 2008 is very important. When the financial crisis hit, everyone was scrambling for cash. Gold fell about 30% from its peak. Silver fell even deeper. Why? Because gold and silver are both highly liquid assets, easy to convert to cash, so they actually got sold off during the panic. People needed cash to pay debts, pay bills, maintain their lives, so they sold the most liquid assets they had. But the key comes afterward. from the 2008 low to the 2011 high. Silver went from about $9 to nearly $50, a gain of over 500%. Gold in the same period went from about $700 to $1,900, about a 180% gain. Silver's explosive power far exceeded gold.
So, if we see a similar credit contraction in the future, we might first see gold and silver get sold off, then surge.
That's possible. But there's an important point. In 2008, most holders were forced to sell because they needed cash flow. If your silver allocation is within the Wealth Emergency Kit framework, meaning you have other liquidity buffers, then you won't be forced to sell at the bottom. You could even add more at the bottom. This is why we always emphasize that allocating physical gold and silver isn't your entire portfolio, it's a defensive allocation after you've done proper risk management. You always need to keep some cash on hand for daily expenses and emergencies.
Corey, what's the current state of the silver market? I remember in January this year, silver hit $121. Now it's back around $76. That's huge volatility.
That brings us to the issue of psychological barriers. Morgan makes a very interesting observation. The $50 price point is a psychological demon for many long-term holders.
A demon?
Yes. After silver hit $50 in 2011 and then fell, many people were trapped for over a decade. When silver broke through $50 again this year, a group of people thought, I'm absolutely not getting fooled again. $50? I'm out. So around $50 there was a wave of profit-taking selling pressure. But this selling pressure only lasted about 7 trading days before silver continued up, reaching a high of $121. Those who sold at 50 watched silver gain another 140%.
Those who sold at 50 must have been full of regret.
Absolutely. But Morgan predicts a similar scenario could happen again at $100. Many people who didn't sell at 50, watched silver surge to 121 and fall back to the 70s, are now thinking, next time it hits 100, I'm definitely getting out. So $100 could be the next shakeout level?
Shakeout meaning washing out holders who aren't committed?
Exactly. The market needs to clear these floating shares before it can continue higher. The question is, how do we know when the market has absorbed this selling pressure and is ready for the next leg up?
I'd like to know that too. Are there any indicators we can watch?
Morgan says the key is watching commercial market inventory digestion, but that's hard to track precisely. More practical indicators are data from the Shanghai Futures Exchange and Shanghai Gold Exchange, as well as Comex registered inventory. What we're seeing now is a very interesting two-tier market structure.
Two-tier market?
Right. On one hand, the retail market between January and May this year saw short-term oversupply due to massive profit-taking. Many dealers say they're getting so many return bars and coins that their warehouses are almost full. These are all retail investors who sold between $50 and $121. But on the other hand, the commercial and futures markets are extremely tight. Comex registered inventory fell from 167 million ounces in October last year to 103.5 million ounces in February this year, a 38% drop. January delivery volume was 49.4 million ounces, 7.27 times the January 2024 volume. And February's delivery rate was 98%, meaning almost all contracts demanded physical delivery instead of rolling to the next month.
That's a huge contrast. Retail is selling while commercial is grabbing?
Exactly right. What does this tell us? It tells us that truly informed institutional money is using retail investors' panic and profit-taking to accumulate massive amounts of physical silver. And the Shanghai Futures Exchange silver price currently has a 12% premium over Comex. That's an extreme tightness signal. Historically, when Shanghai's premium exceeds 10%, it usually means the Chinese market is aggressively buying while Western inventories are rapidly flowing east.
Why is there oversupply in the retail market? Does that mean regular investors are losing confidence in silver?
Not entirely. It's more about human nature and psychological barriers. Many people held silver for years, finally saw the $50 breakthrough, got excited but also feared getting trapped again, so they chose to take profits. Some people genuinely needed cash and liquidated when prices were good. This is a natural market phenomenon. It doesn't mean silver's fundamentals have problems. In fact, the Silver Institute predicts 2026 will be the 6th consecutive year of structural deficit. with an estimated deficit between 46 and 67 million ounces. From 2021 to 2026, cumulative deficit has exceeded 800 million ounces, equivalent to 1 year of global production.
6 consecutive years of deficit. Where are inventories coming from?
From above-ground stocks. But above-ground stocks aren't infinite, and the drawdown rate is accelerating. The Silver Institute says the global silver market has entered an era of inventory decline. Those are their exact words. This is why the commercial market is so tight, while retail market short-term oversupply is actually an opportunity for long-term bulls. When retail investors take profits at $100, institutional money will come in again to accumulate, then drive the next leg higher.
Corey, you mentioned the bond market earlier. How does that relate to gold and silver?
The bond market is what Morgan considers the most important indicator to watch in 2026. For the past few decades, central banks have basically controlled bond market pricing through quantitative easing and interest rate manipulation. But now, the situation is changing. Bond yields in the UK, Japan, and the US are all rising. Even though central banks are trying to suppress rates, the market isn't buying it.
What does that mean?
It means the market is taking back pricing power. Rising bond yields mean investors' trust in these countries' future debt repayment ability is declining. They're demanding higher returns to compensate for risk. Morgan uses a great analogy. Interest rates tell you what the currency is worth. Zero interest rates mean the currency is almost worthless because borrowing money has no cost. Now rates are rising, not because the economy is improving, but because investors are demanding higher risk premiums. They're saying, I don't trust you can pay me back, so you need to give me higher interest. And what's different this time is that 3 major economies, UK, Japan, US, are seeing this simultaneously. That's not coincidence. It's a global trust crisis.
This is the beginning of trust collapse.
Exactly. When bond market investors don't believe governments can repay debt, money printing loses its effect. Think about it. If central banks print money to buy bonds, but the market demands higher and higher rates, that means the printed money is no longer trusted. At that point, the only assets that can truly preserve value are those that don't depend on any government credit, physical gold and silver. Venezuela is the perfect example. When the currency collapsed, paper bills were scattered in the streets, and no one picked them up because they had no value. The dollar won't become Venezuela, but the trend is the same purchasing power continues to be diluted.
So Hong Kong's clearing system, silver's psychological barriers, rising bond market rates, these seemingly unrelated things are all pointing in the same direction.
Exactly. They're all telling us the old financial order is loosening. The new order hasn't been established yet. During this transition period, paper assets carry the highest risk. Allocating physical gold and silver isn't about short-term profits. It's about ensuring that in future environmental turmoil, your family's wealth and monetary purchasing power won't be diluted by fiat currency. This isn't speculation. It's insurance. Just like buying homeowners insurance, you don't hope your house burns down, but if it does, you won't be left with nothing.
What's your outlook for gold and silver in the second half of this year?
Morgan expects we might enter a wide-range consolidation phase over the summer. Historically, May through August is the traditional off-season for precious metals, and prices usually consolidate. But that's not a bad thing, it's actually a good time to accumulate physical. And this year, there's another variable. The Federal Reserve's interest rate policy. The June meeting is not expected to cut rates, but if they cut in the second half, and the bond market ignores it, and continues pushing rates higher, that's Morgan's ultimate signal. The market no longer trusts the central bank. At that point, gold and silver could enter the next accelerated rally.
So what we need to do now is continue accumulating physical and wait patiently.
Right. Remember, we're not betting on short-term price volatility. We're preparing for long-term financial system restructuring. The $100 psychological barrier might come, but that's just a shakeout to wash out uncommitted holders. Those who can cross cycles are those who understand the essence of physical gold and silver. It's not a speculation tool, it's wealth insurance. We plan, God provides. What we can do is see the trend clearly, do our part, then wait with reverence for time to give us the answer. See you next time.
See you.